Welcome to Singapore Property Talk Law. We're jumping straight into the key trends shaping Singapore's property market in the first quarter of 2025.
Yeah, we got the latest stats right here.
Exactly. And our mission really is to unpack what it all means for you. Think of this as your shortcut, your quick guide to the latest property data.
Okay, let's dive in. The big headline here is definitely a slowdown in private residential price growth.
A slowdown. How much?
Well, the overall index saw just a 0.8% increase in Q1. That's quite a step down from the 2.3% jump we saw in the previous quarter.
Okay, 0.8% versus 2.3%. That's noticeable.
It really is, and it suggests, a definite cooling in that rapid price growth we were seeing.
So where is this cooling happening most? Is it across the board?
Well, landed property prices just edged up slightly at 0.4%, which actually reverses a small dip from Q4.
Okay, a tiny increase for landed.
But non-landed property prices, they increased by 1.0%. Now, that sounds okay, but compared to the 3.0% rise in the quarter before.
Ah, right. So a significant slowdown for non-landed as well.
Exactly. And if we break down those non-landed properties by region, this is where it gets interesting.
Okay, CCR, RCR, OCR.
Yep. So core central region, the CCR, price increase slowed to 0.8%. Still growth, but down from 2.6%.
Okay.
Rest of central region, RCR, similar story. It slowed to 1.7%, down from 3.0%.
Right, both slowing.
But the outside central region, the OCR, that saw the biggest change, prices there increased by only 0.3%.
0.3. Wow, compared to what?
Compared to 3.3% in Q4 2024.
Okay, that's a huge difference. So the suburbs, the OCR, really felt the brakes.
It certainly looks that way. That regional breakdown really shows where the cooling is most pronounced. Might point towards, affordability becoming a bigger factor out there.
Makes sense.
Okay.
What about the rental market? Any slowdown there too?
Actually, the rental market showed a bit of a different trend. The overall private residential rental index saw a slight increase, 0.4% in Q1.
Oh, an increase after being flat before.
Yes, exactly. It was unchanged in Q4 2024, so this 0.4% rise indicates, a mild upturn in rental growth.
Interesting. How does that break down? Landed versus non-landed?
Landed property rentals rose by 0.3%. That's a turnaround from the 1.8% decrease they saw previously.
Okay, back into positive territory for landed rentals.
And non-landed rentals increased by 0.5%. That's also a bit higher than the 0.2% rise in Q4. So, yeah, slight acceleration there.
And regionally?
Yeah.
For the non-landed rentals?
Right. Looking across the regions, CCR saw its rental increase slow down a bit to 0.4% from 0.9%.
Yeah.
RCR saw a similar small increase, 0.4%, which was slightly up from 0.3% before.
Pretty steady.
But the OCR, again, showed a notable shift. Rentals there increased by 0.7% in Q1.
Increased. After what?
After seeing a 0.8% decrease in the previous quarter.
Huh. So prices are cooling significantly in OCR, but rentals are actually picking up there.
It seems counterintuitive, perhaps, but yeah.
Yeah.
Maybe that price cooling makes renting there relatively more attractive, or perhaps demand is shifting. It's an interesting dynamic.
Definitely something to watch. Okay, let's talk about supply. New launches, sales. What happened in Q1?
Developers launched slightly fewer uncompleted private units, excluding ECs, of course, around 3,139 units in Q1, compared to about 3,425 before.
So a small dip in launches. And sales.
Sales were also slightly lower, 3,375 units sold, again excluding ECs, versus 3,420 in Q4. So a bit quieter on that front.
But you mentioned EC as executive condominiums. What about them?
Ah, yes. The EC market was quite a bit busier. 760 units were launched in Q1.
More than the previous quarter?
Oh, yes. Significantly more than the 504 launched in Q4. And sales were strong, too. 830 EC units sold in Q1.
830 sold. Wow, compared to
528 sold in Q4. So, yeah, definitely more activity in the EC space.
Why do you think that is, the EC appeal?
It likely comes down to that unique positioning, bridging public and private housing, hitting a specific affordability point. Demand seems robust in that segment.
Makes sense. What about the secondary market, resales and subsales?
Resale transactions saw a small dip, down to 3,565 units from 3,702, but they still make up nearly half, 49.1% of all sales.
Yes,
so
yeah.
Still very significant.
Still the bulk of the market, basically.
Pretty much. Subsales, those are sales before completion, increased just slightly to 321 units from 311. Still a small slice, about 4.4% of total sales.
Okay, so the secondary market is relatively stable overall. Now, looking forward, supply. What's coming down the pipeline?
Right. Completions and future supply. In Q1, about 1,988 private residential units, including ECs this time, were completed.
Okay, units hitting the market now.
But the pipeline, the future supply, that's pretty substantial. We're looking at around 55,600 private units, including ECs, expected to be completed in the coming years.
55,000, that's a lot.
It is. And for 2025 specifically, about 7,200 units are expected to be completed.
And the government is adding to this.
Yes, the government land sales, the GLS program, is definitely ramping up supply. The plan for the first half of 2025 includes sites for about 5,030 units. That's roughly 60% higher than the average from 2021 to 2023.
Wow, a big increase in land release.
They're clearly aiming to ensure a steady stream, adjusting based on the market, of course. And specifically for ECs, the supply plan for 2025 is set to be the highest in recent years.
Really? How many?
About 2,000 units across 5 sites are planned for ECs in 2025. That's nearly double the average yearly launch from 2021 to 2023.
Okay, so a big wave of ECs coming, matching that demand we saw.
Seems to be the plan.
With all this supply coming, what about current unsold stock and vacancy rates?
Interestingly, the unsold inventory, units with planning approvals but not yet sold, actually decreased in Q1. It went down to about 18,125 units, excluding ECs.
Decreased, even with new launches.
Yep, down from 19,405. Including ECs, the total unsold was about 19,604, down from over 21,600. So demand is still absorbing available units.
Okay, that's positive for developers. Vacancy rates?
The overall vacancy rate for completed private units, again excluding ECs, dipped slightly to 6.5% from 6.6%.
So pretty stable vacancy overall. Any regional differences?
Oh yes, the CCR vacancy rate is still quite a bit higher, sitting at 10.3%.
10% vacancy in the core.
Yeah, compare that to RCR at 6.6% and OCR down at 4.7%.
Much lower vacancy outside the core. Suggests maybe softer rental demand at the very high end.
That could certainly be a factor, yes. Consistent with the slightly slower rental growth we saw in the CCR too.
Right. Okay, quickly, before we wrap up commercial property, office and retail.
A bit of a mixed picture there.
Right.
For offices, prices saw a smaller decrease, just 0.2% compared to 0.7% before. And rentals actually increased slightly by 0.3% after a previous decrease.
So office market stabilizing a bit.
Perhaps, but the island-wide office vacancy rate increased to 11.7% from 10.6%.
Okay.
For more empty space despite slightly better price rent trends.
Okay. And retail?
Retail prices actually saw a rebound, increasing 1.9% after a 1.3% decrease.
Oh, positive for retail landlords.
Price-wise, yes. But retail rentals decreased by 0.5%, reversing a previous increase. And like offices, the retail vacancy rate also went up to 6.8% from 6.2%.
So retail prices up, but rents down and more empty shops.
Complex. Very mixed signals, yeah. Likely reflects ongoing shifts in how we work and shop. Also, supply in the pipeline decreased for both office and retail.
Okay. And all of this is happening against what kind of economic backdrop?
Well, the broader context is important. Singapore's GDP growth for 2025 is forecast to slow down, maybe 0.0% to 2.0%, which is, quite a bit lower than the 4.4% last year.
A significant slowdown projected.
Yes, amid global trade issues and economic uncertainty. Plus, while interest rates might have eased from their absolute peaks, they're expected to stay higher than the super low levels we got used to over the past decade.
Right. Higher rates, slower growth.
Yeah.
That definitely underlines the need for caution.
Absolutely. Financial prudence is really key when making any big property decisions in this environment.
So let's try and summarize. Q1 2025. We're seeing a clear moderation in private home price growth, especially non-landed and particularly out in the OCR.
Right. But the rental market saw a slight overall pickup, interestingly with OCR rentals showing strength.
And while launches and sales were a bit quieter overall, the EC market was buzzing.
Definitely. Plus, there's a very significant supply pipeline building up, especially for ECs, thanks to active government land sales.
Unsold stock is decreasing, though, and vacancy rates are relatively stable, although higher in the CCR.
And commercial is, well, a mixed bag. Office showing some stabilization, maybe retail seeing price recovery, but rental pressure and rising vacancy.
So, putting it all together for you, the listener, the first quarter paints this picture of a market that's adjusting. Price growth has cooled, rentals are nudging up slightly, and there's a lot of supply on the way.
And the broader economy suggests, a more cautious approach is probably wise.
Exactly. Financial prudence is the watchword. We hope this run-through gives you a clearer picture of where things stand right now. Of course, it's just a snapshot.
The market is always evolving.
Absolutely.
Yeah.
So what stands out most to you from these Q1 trends? Does this change how you're thinking about your own property journey? Definitely something to keep mulling over as we move through 2025.